So how to do the first thing? So you are to conclude on those particular techniques of measuring the risk. So the last one we did was risk adjusted discount rate. The last one we did was the risk adjusted discount rate. So when it comes to the risk adjusted, so we finished the risk adjusted discount rate, isn't it? Yeah, so let us now go to the utility theory. We do the utility theory. We can check the utility theory so that we can be able to conclude or not. We can now go to the utility theory to see how we can be able to make use of that. So when it comes to utility theory, what happens on the utility theory is that a project is normally meant to give you the returns. So you compare those returns against your expectation so that we can be able to tell what satisfaction are you going to get from a given combination. So utility is simply the satisfaction that someone will be able to derive from investing in a given project. Remember, satisfaction can be actually classified into three. We can be neutral, risk taker, or risk averse. So utility theory is simply meant to ensure that utility theory. So when it comes to utility theory, we are simply concerned about the satisfaction that an investor can derive from the income invested in a project. Then they also say that more income means more utility. More income means more utility. Then utility is normally measured in terms of the utilities. Utility is normally measured in terms of utilities. Then investors can be classified into three categories as risk as is concerned as follows. So there is a risk taker. When it comes to the risk taker, these are those investors who prefer high risk, high return investments. Therefore, they are willing to invest more even if they get less returns. Then also they can be risk averse. For the risk averse, these are those investors who prefer low risk, low returns investments. Therefore, they are willing to invest, but to get, so that one should be, therefore they are willing to invest, but to get more return. Something's missing there. That sentence should be that under the risk averse should read that these are those investors who prefer low risk, low return investment. Therefore, they are willing to invest less. Now, what less up in a mix, but to get more returns, but to get more returns. Number three is meant to be risk neutral. So when it comes to risk neutral, they are those investors who use the expected returns or average returns to make their investment decisions, So I've also given you limitations of the utility theory, which were examined in the sitting of May 2016, question 1, part A. When you go to May 2016, question 1, part A, there are those limitations of the utility theory. So go through them and see how best they can assist, because that's now the only question on the utility theory that were tested. They only tested a theory question. But I want to do that illustration following up. But there's no question in your past papers, but I want to do that illustration. You can see down there where they are saying that consider an investor, not an illustrator. Consider an investor who is presented. Consider an investor who is presented with the following lotteries. Consider an investor who is presented with the following lotteries. So we are doing an illustration under the utility theory. There is an illustration on the utility theory that they consider an investor, not illustrator, who is presented with the following lotteries. A, 0.5 chances of receiving a 0. Then also 0.5 chances of receiving shillings 100,000. The price to pay for the lottery is 33,000. The price to pay for the lottery is 33,000. Then B, there is 0.3 chance of receiving a 0. 0.3 chance of receiving a 0, and also 0.7 chance of receiving 33,000 shillings. So the price to pay would be shillings 21,000. Then also there is 0.4 chance of receiving shillings 33,000. Then also 0.6 chance of receiving 100,000. So the price to pay will be 63,000 shillings. So required, Roman letter 1, determine the utility values of shillings 33,000, 63,000, and 21,000 respectively. Roman letter 2, state the risk attitude. State the risk attitude and plot the utility function. Then Roman letter 3, state the type of the utility function for this investor. State the type of the utility function of this investor. So what I want to do, I just combine all of them together, then we find, because that's the only question I'll be able to do on the utility theory. There is no other question that is there on the utility theory in your past paper. So we are simply doing the question on the handout. You check on the handout under the utility theory, there is a question there that you are dealing with. So we start off with the lottery A. We start off with 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 lottery A. When it comes to lottery A, I want us first to get the risk attitude of that investor. So to get the risk attitude, we first calculate the expected returns. We first calculate the expected returns. We shall first compute the expected returns. So to get the expected returns, there is 0.5 chance of receiving a 0, and also 0.5 chance of receiving 100,000. So we need to combine them together and see what should be our expected returns from there. We want to know what should be our expected returns. So it should be able to give us a value of how much? So it should be able to give you a value of 50,000. So we compare that with the price to pay. We compare that with the price to pay. So price to pay was given under lottery A. The price to pay for lottery is meant to be 33,000 shillings. Is meant to be 33,000 shillings. The price to pay is meant to be 33,000 shillings. The price to pay is meant to be 33,000 shillings. So you can see this person wants to get 50,000, but is only willing to pay 33,000. So he's a risk averse. He's willing to pay less, but to get more returns. So you make a conclusion, you write down there that this is a risk averse investor. This is a risk averse investor. It is a risk averse investor because he's willing to pay less. Because he's willing to pay less in order to get more returns. Because he's willing to pay less in order to get more returns. Is willing to pay less in order to get more returns. So we can compute the utility. We can calculate the utility of shillings 33,000. What is willing to pay? What satisfaction is we going to get from that? So to get the utility, remember, utility is measured in terms of U types. It normally ranges from 0 to 1. When you win, you get 1. When you lose, you get a 0. So the satisfaction you derive will be able to range from 0 to 1. So we want to get the utility of shillings 33,000. It will be equal to 0.5 of the utility of receiving 0 shillings plus 0.5 of the utility of receiving shillings 100,000, like that. So we can be able to summarize it in that order. We can be able to summarize it in that order because he wants to pay 33,000 shillings, but there are two possibilities from that. There are two possibilities from that. There is a possibility of getting a 0. There is also a possibility of getting 100,000. So when you have invested that 3,000 shillings, we are looking for the utility of this amount. We are looking for the utility of that 3,000 shillings. So there are two chances, 0.5 of getting a 0. So that's now 0.5 of the utility of getting a 0. Plus also 0.5 of the utility of getting 100. So there are just two options. Either you win or you lose. When you lose, you get a 0 utile. When you win, you get 1 utile. So in this one, you got a 0. So that means it will be 0.5 of getting 0 utile. Then this other one will be 0.5 of getting 1 utile. Because he has won, there are two possibilities. A possibility of getting a 0 and also a possibility of getting 100. So when you win, you get 1 utile. When you lose, you get 0 utile because utility ranges from 0 to 1. So utility normally ranges from 0 to 1. So if 1 point you get 50, the other one 50, then it will be 0.5 and 0.5. But this one, he has gotten a 0 in 1 point. The other point, he has gotten 100,000. So that's now for lottery A. That now will be for lottery A. So we go to lottery B. We now also go to lottery B. We also go to lottery B. When it comes to lottery B, it is meant to be expected returns. Expected returns is meant to be. You can see lottery B, there was 0.3 of getting a 0, and then also 0.7 of receiving that 3,000. So we simply get expected return from that. 0.3 of getting a 0, then also plus 0.7 of getting that 3,000 shillings, of getting that 3,000 shillings. So we get 23,100. We get 23,100. But you can see the price. The price to pay. So the price to pay was how much? Under lottery B, he was able to pay 21,000. He was able to pay 21,000. So what it means that even this one is a risk averse. He's willing to pay this, but to get 23. So you comment there that the investor is risk averse. The investor is risk averse because he's willing to pay less. Because he's willing to pay less, but to get more returns. because he is willing to pay less, but to get more returns. So now we want to compute the utility of the 21,000 shillings. We can now calculate the utility of the 21,000 shillings. The utility of the 21,000 shillings. So to get the utility, so utility of the 21,000 shillings, we want to see how to get the utility of 21,000 shillings. The utility of shillings, 21,000. So the utility of the 21,000 shillings, for us to get the utility of shillings 21,000, it is equal to 0.3 of the utility of receiving 0 shillings plus 0.7 of the utility of receiving shillings 33,000. Like that. So you want to know how many utils is he going to receive at that portion. So for this one, satisfaction will not change. Satisfaction will always remain the same. But there is a place he had paid 21. There is a place he had paid 21. Then, sorry, there's a place he had paid that 3,000. So you remember the first lottery? When he paid that 3,000, he got how many utils in lottery A? Because we calculated the utility of that 3,000 shillings. We got how many utils? 0.5. So I was saying satisfaction of paying and receiving will not change. The satisfaction of paying and receiving will remain the same. So in the first lottery, he was willing to pay that 3,000 shillings and he got 0.5 utils. So this time around, when it comes to this portion, when he receives now that 3,000, it will be the same as the satisfaction he got when he paid. Remember lottery A, when he paid, he got 0.5. You saw satisfaction will not change. When you pay and when you receive, the satisfaction will remain the same. Because in the first lottery, he paid that 3 and he got 0.5 utils. So even this time around, when now he received that 3,000, he will be receiving 0.5 utils. So this one will be 0.3 of receiving 0 utils. But this one will be 0.7 because the first lottery he paid that 3. He received. So now when he received this one, he will still get the same satisfaction, which was 0.5 that you calculated in lottery A. Lottery A, he had paid. Satisfaction would not change. Will remain the way it was when you pay and when you receive. So we shall be, because it is a continuation, from A, B up to C. It is like now, you have seen people on the street playing characters, isn't it? When you play the first one, and they don't normally allow you to go away. You go like 3 times, but finally then they win, isn't it? Yeah, so we are now in such a situation whereby we are participating in 3 lotteries. So the satisfaction you got when you paid that 3 will be the same satisfaction you get when you receive that 3,000 shillings. So that's now for lottery B. So let us now go to lottery C. Let us now check lottery C. We now go to lottery C. We now go to lottery C. We now go to lottery C. So when it comes to lottery C, we have the utility expected return. We start off with the expected returns. So expected returns, you simply take 0.4 0.4 of the 33,000 shillings. Then we also add 0.6 of 100,000 shillings. Of 100,000 shillings. So we get 73,000. 73,200. So we compare that with the price to pay. We compare that with the price to pay. So price to pay, you can see they have given us 63,000. The price to pay, they have given us 63,000. So when you compare them, this person is still risk averse. You comment that is a risk averse investor because he's willing to pay less, but to get more returns, because he's willing to pay less, but to get more returns. He's willing to pay less, but to get more returns. So we also compute the utility. We also calculate the utility of shillings 63,000. Utility of 63,000. So to get the utility of shillings 63,000. So utility of shillings 63,000 would be equal to 0.4 of the utility of shillings 33,000 plus 0.6 of the utility of shillings 100,000. So now this time we go back to lottery A and lottery B. We go back to lottery A and lottery B. So you remember there is a place where it was 33,000. When it was 33,000, you remember in lottery A, it was 0.5. So this one will be 0.4 multiplied by 0.5. Also in lottery A, remember lottery A, there is a place he received 100. We gave him how many lotteries? 2 times. When it was 100. When it was 100, we gave him 1. Isn't it? Yeah, so you see it was 0, a probability of 0.5 of receiving 0 and a probability of receiving 100. You see when we calculated that part, because already that was an option where he got a 0. When he got a 0, he was given 1 UTITE. When he got 100,000, he was given 1 UTITE. So the same satisfaction would remain. When he receives 100, he will still get 1 UTITE that we had given him earlier in lottery A. So now when we combine, finally it will be 0.8. So I want us now to plot that information on the diagram. I want us now to plot that information in the diagram to see the utility function. I know you did some of these things in your economics, the utility functions. Yeah, so that's now what we want to create. But in terms of the satisfaction that you have derived from a given function. So let us draw the diagram to show the utility function. We now draw a diagram in order to show the utility function. So in our diagram, we can have it like this. We can have it in that manner. So this side, we put there U types. This side, we put there U types. This side is amount. So utility, it ranges from 0 to 1. So I will have it in that manner. So 0.1, then 0, 0.2, 0.3, 0.4, 0.5, 0.6, 0.7, 0.8, 0.9, 1.0. Maybe we can include there 1.1 like that. So utility is measured. So it ranges from 0 to 1. It ranges from 0 to 1. Then also the amount, the highest amount was 10,000. The highest amount was basically 10,000. Yeah, 100,000. The highest amount was, so I will reduce them by 3 zeros like that. So that I start with the first one as 10,000. Then the second one as 20,000. I've put 3 zeros there to reduce those number of the zeros. Then this one will be 30, 40, 50, 60, 70, 80, 90, up to 100. Up to 100. So there are 3 lotteries that you are able to come up with. We start with the first lottery. The first lottery, you was willing to pay how much? Lottery A, the price to pay. It was 33,000. So 33,000 is around this region. 33,000 is around that region because it is between 30 and 40. But when we calculated that, we got how many liters? 0.5. So remember, lottery A gave us 0.5. Yeah, so it is 33, and this one is 0.5. We locate that point. Locate that particular point. So 33, then 0.5. Like that. The next one is meant to be the lottery number 2B. So lottery B, he was willing to pay 21,000. So 21,000 is around this region. 21,000 is around that region. 21,000 is around. So how many units are there for lottery B? So when it is 21,000, we have 0.35 somewhere here. 0.35 somewhere there. 0.35 somewhere there. Then the last one was willing to pay how much? So when he was willing to pay 63,000, is around that region. So that one he got how many liters? So we got up 0.8. We got up to 0.8 like that. So that is normally a linear base. So we shall be able to present it in form of a graph. So it originates from here. So it is a quadratic function. It will be a quadratic function like that. So we join it as a curve like that. We shall be able to join it as a curve in that order. We shall be able to join it as a curve in that level. So when we join it as a curve, it is a quadratic function. It is normally meant to be a quadratic function. So that is simply a quadratic function for the risk averse. You know, all of them were risk averse. So this is risk averse. So this one will be risk averse investor. Is a risk averse investor. But if you do a question which will be giving you risk taker, the utility function for the risk taker is just a reflection. It will be going like that. So this is just a demonstration. When you get a question which will give you the risk taker, when you draw, it will be appearing like that. So we can just show it. This one is supposed to be a risk taker investor. But if you get risk neutral investor, the utility function will be a linear function. So this one will be the risk neutral investor. So that one will be risk neutral investor. So that is when you draw, when you calculate and all of them are risk neutral, the utility function will appear like that. But if all of them are a risk taker, it will appear in that manner. But for this one, all of them were risk averse. That's why it appeared in that order. So we can just comment something brief on that. We can comment something brief on that by summarizing that the utility function of a risk averse investor, the utility function of a risk averse investor is normally a logarithmic function, which is concave to the origin, which is concave to the origin, which is meant to be concave to the origin. Then another paragraph is that the utility function of a risk taker investor, the utility function of a risk taker investor is a quadratic function. Sorry, a logarithmic function, not quadratic, is a logarithmic function, which is convex, which is convex to the origin, Then another paragraph, we note that the utility function of a neutral investor, the utility function of a risk neutral investor, is a quadratic function, of linear nature, which is a straight line, from the origin, which is the straight line from the origin. So that is now what I can say on the utility theory, because there is no questions in the past papers in relation to that, except the one for the theory I had indicated for you. So there is one item remaining. Did we do the one for the scenario analysis? Yeah, so we can now conclude on the one for the scenario analysis. In the handout. So when it comes to the scenario analysis, it must be the last one. They are saying that this is the use of the horizon analysis, where we determine the future NPV of the project by subjecting the project to different extreme ends of the operation, i.e. the worst, the best, and the best, which is compared with the expected or average, in order to determine the risk of the project. So under sensitivity analysis, items are analyzed in isolation. However, we assume that under the sensitivity analysis, items are analyzed in isolation, where we assume that they are independent. However, under the scenario analysis, we assume that variables are interrelated. The variables are interrelated. So it is the same concept like the one for sensitivity analysis. But under the scenario analysis, we analyze all the items combined. We make all of them the best. We make all of them the worst. We make all of them average. Then we compute the NPV, we compare them. But for the sensitivity, you are taking each item at a time. Then you make it a constant. Then others constant, then we come up with that. So the only question I've seen there is the question for May. There is a question in your past paper on the scenario analysis. There's a question for the sitting of November 2019, question 1, part C. November 2019, question number 1, part C. There's a question for the sitting of November 2019. November 2019. November 2019. Question number 1, part C. We had already done part B, November 2019. There is a question number 1, part C. November 2019. There is a question number 1, part C. So that question 1, part C, the question read that further analysis of the company in part B above suggests that sales volume could depend on the expected economic conditions, on the expected economic condition of states as follows. So economic state, they have given us poor, normal, and what? Good. They also gave you the probability of each occurring, then annual sales volume, all of them. So required the expected net present value of the project using the scenario analysis. The expected net present value of the project using the scenario analysis. So that's now the question, how to go about. So the only thing that is different from the other, the sensitivity analysis, we were analyzing each item in isolation. But now we combine this poor, normal, or good. We combine them together to give us expected sales volume. Then we compute the new NPV. So what you will do first, you calculate the expected sales volume in units. We simply get the expected volume in units. The expected volume in units. So we simply come up with the expected sales volume in units. Expected sales volume in units. So to get the expected sales volume in units, you take each, like the first one is 17.5 millions. 17.5 millions. We multiply by 0.3. Then we add. The second one is made to be 20 millions. We multiply by 0.6. The last one is meant to be 22.5 millions. Then we multiply by 0.1. You see the one that they were combined under normal? On a 0.6, the other one should be shifted to good. So good is 0.1. So when you check through the question, there was misarrangement under the normal. Normal, there is 0.6, 0, then also 0.1. The one for the 0.10 should be shifted to good. Should be shifted to good to give you the number of the units for that. So there will be how many units? So you combine them together, then we see they should be able to give you how many units for that particular portion. You get 19.5. You'll be able to get 19.5 million units. So now after that, you want to compute the annual cash inflows. The annual cash inflows. So annual cash inflows, you remember P minus B minus X minus F. So we were multiplying by 1 minus the tax rate, then we added depreciation, but this one shall not go to that direction because this question had no tax. This question had no tax. So we shall just calculate them on the basis of that. So we go back to the part B. We go back to the part B to see what is our P. We go back to part B to see, because the question was an extension of part B. So when you check under part B, what we have as the selling price per unit on the part B of the question. The selling price per unit was 3. So it will be 3 minus B. B is the variable cost per unit, which was given as 1.65. Then now the volume, which is X, is the 19.5 millions. Is the 19.5 million. So F was the fixed cost, which were given in the first paragraph. So expected that 20 million units will be sold. Then when you say the incremental fixed cost were how much? 10 million. So we minus the 10 millions so that we get now the annual cash inflows. So that we come up with what is meant to be the annual cash inflows. 16.325. So we are calculating the NPV. So NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. You want to get the NPV, which will be given by present value for the cash inflows. We minus the present value for the cash outflows. So this one is the present value for the cash inflows, where we take the annuity, we multiply by the present value interest factor for the annuity. The cost of capital was given as 12% in part B of the question, and the project was supposed to be there for 5 years. So your annuity is the 16.325 millions. Then you check in the annuity table. You check in the annuity table what is meant to be 12% in year 5. 3.6. Yeah, so that will give you the present value for the cash inflows. So you less present value for the cash outflows. When you check under part B, it was meant to be 50 millions. So you minus the 50 millions, then you get the NPV for that. So if it will be positive, we shall be accepting the project. But if it will be negative, we reject the project. So when it comes to scenario analysis, we simply subject the project to different worst conditions. The different status, the best, the worst, and the average, which are then combined together, then you get the NPV. So even that one, there is no other question except that. So is it positive or negative? So if it is positive, I advise them that accept the project, accept the project, accept the project. So we don't have much on that topic, but my advice for you, they have been testing 3 parts. They have been testing 3 parts: decision tree diagram, simulation, and the sensitivity. But for the last 5 sittings, sensitivity has not been tested. They have tested decision tree 3 times, decision tree 3 times, simulation twice. So we expect them to test you now on this element of the sensitivity. Then most of the time they have been testing is on the break-even point analysis. The last twice that they have tested has been on the break-even point analysis. So we can also be able to make that consideration when we do our revision. So today I want us to start on the mergers and acquisition. We now start on the mergers and acquisition. Yeah, so online, check whether you can get the notes for the mergers and acquisition. We start a new topic. So we can now go through mergers and acquisition. We can now go through mergers and acquisition. So when we go through the mergers and acquisition from the handout, so there is M there. So when you check through, they are saying that a merger is simply a combination of two or more equally strong companies to form a new entity. So the original companies will lose their original identity after the merger, and none of them will dominate each other after the merger. But there is also acquisition or takeover. It is simply a situation where one company known as the predator will acquire or take over another company known as the target. But after the acquisition, the target will disappear, but the predator will retain its original identity. So that is now the difference between mergers and acquisition. I've given you types of mergers and acquisition. You go through them. I've also given you reasons for mergers and acquisition. There are basically 6 of them. So I want you to take some time, you go through them. Then I've given you defensive mechanisms or tactics of the target in case of the hostile takeover. So you check through those terms, the uses, the defensive tactics. Then apart from that, my concern there are the forms. You can see forms of consideration in case of the mergers or acquisition. They can be share for share exchange. They can be share for share exchange, that is being then A as payment in cash, then C should be use of the convertible securities. So I would like you to go through them like that, because that is just a small summary of the notes on the mergers and the acquisition. So go through the summary of those handouts, because they are normally tested in most of the cases when they test a question on that. So what I want us now to do in your notes, we can have a subtopic as evaluation of mergers and acquisition. We can write in our books as evaluation of mergers and acquisition. We can now have in our books as evaluation of mergers and acquisition. Evaluation of mergers and acquisition. So under that, we can write that after the merger and or acquisition, earning per share of the predator, Remember, the predator is the company taking over another company. The earning per share of the predator is normally expressed as follows. It is normally expressed as follows. Depending on the nature of consideration. 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 So we start with the A. A is share for share exchange. Share for share exchange. Share for share exchange. Share for share exchange. So normally, when it comes for the share for share, we give out shares in order to acquire the shares in the target company. but we are not going into detail for that. What I want to show you is how to get the earning per share when it is share for share exchange. So to calculate, so I'll just simply give you the formulas. Earning per share of earning per share, sorry, it should be acquisition, earning per share of the predator, earning per share of the predator. So it is supposed to be given by the combined earnings of the predator and the target. Combined earnings of the predator and the target. Then we divide by number of the ordinary shares of the predator. Number of the ordinary shares. Ordinary shares of the predator. Number of the ordinary shares of the predator. Then we add number of the new shares to be issued. So shares to be issued, we add number of the shares. Number of shares to be issued to acquire the target. So when it is share for share exchange and we want to compute the earning per share of the predator after the merger, we simply get combined earnings of the predator and the target. We divide by the number of the ordinary shares of the predator, but we add number of the shares to be issued to acquire the target. So that's now indicates it is share for share exchange. That's now when we use the share for share. But sometimes we can also use debentures. So B will be use of the debentures. We can also use debentures to acquire the target. We can also use debentures to acquire the target. So when it comes to the use of the debentures, and we want to compute earning per share of the predator, it will simply be given by the combined earnings, the combined earnings of the predator and the target. Then we subtract debenture interest, then we add the interest tax benefit. We add the interest tax benefit. We add the interest tax benefit. Add the interest tax benefit. Then we divide by number of the ordinary shares. Number of the ordinary shares of the predator. Number of the ordinary shares of the predator. We add the number of the ordinary shares of the predator. That's now when it is use of debentures. Then apart from that, we can also have use of the preference shares. Use of the preference shares. We can have use of the preference shares as a source of financing. We can also use. So when we use the preference shares, when we apply the preference shares, earning per share of the predator, earning per share of the predator, It is supposed to be given by combined earnings. The combined earnings of the predator and the target. Combined earnings of the predator and the target, but we minus the preference dividends. The preference dividends. The preference dividends. Then we also divide by number of the ordinary shares of the predator. Number of the ordinary shares of the predator. Number of the ordinary shares of the predator. So we have those three key ways of financing. We can use share for share exchange, we can use the debentures, or we can issue the preference shares. So it goes by what will be necessary to be applied when it comes to the mergers or acquisition. So that's now the first part. Let us now also have a brief subtopic as exchange ratio. We can also have something brief. So this last one is the use of the preference shares. You just get the combined earnings of the predator and the target. The combined earnings of the predator and the target. Combined earnings of the predator and the target. Then you subtract the preference dividends. You subtract the preference dividends, but you divide by the number of the ordinary shares of the predator. So now after that, I would also like us to write something brief about exchange ratio. We can also write something brief concerning the exchange ratio. We can also write something brief about exchange ratio. Exchange ratio. About exchange ratio. So when it comes to the exchange ratio, we are simply looking for how many shares should we give out in order to acquire one share. That's now when it comes to the exchange ratio. So we can just summarize that exchange ratio. It indicates the number of the shares to be issued by the predator. It indicates the number of the shares to be issued by the predator. It indicates the number of the shares to be issued by the predator in order to acquire one share of the target. So it indicates the number of the shares to be issued by the predator in order to acquire one share of the target. In order to acquire one share of the target. It is expressed as follows. It is expressed as follows. It is expressed as follows. So when you want to calculate the exchange ratio, when you want to compute the exchange ratio, it is supposed to be given by offer price by the predator. Offer price by the predator. Offer price by the predator. Then we divide by market price per share of the predator. 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 So when it comes to the exchange ratio will simply be given by offer price by the predator. We divide by market price per share of the predator. We divide by market price per share of the predator. So that's now how we shall be coming up with the exchange ratio. So the other item I also like you to know is about the break-even point. You can also write something brief about break-even break-even point or non-diluting offer price. Non-diluting offer price. I would also like you to understand what we mean by the break-even point or non-diluting offer price. The break-even point or non-diluting offer price. So when it comes to the break-even point or non-diluting offer price, we shall be looking at it in terms of that particular price at which earning per share before the merger is the same as after the merger. That's now what we'll be referring to as the break-even point or non-diluting offer price. So we just comment that this is an offer price. This is an offer price where it is an offer price where earning per share, after the merger, where earning per share after the merger, where the earning per share after the merger would remain the same as, where the earning per share after the merger will remain the same as, earning per share before, will remain the same as the earning per share before the merger, would remain the same as the earning per share before the merger, the earning per share before the merger. And it will be expressed as follows. And it will be expressed as follows. And it will be expressed as follows. It will be expressed as follows. So you want to see how to compute the non-diluting offer price. So to calculate the non-diluting offer price, to come up with non-diluting offer price, non-diluting offer price. It is supposed to be given by, the price earning ratio. The price earning ratio, the price earning ratio of the predator. The price earning ratio of the predator before the merger. Then we multiply by earning per share of the target, earning per share of the target also before the merger, When you want to compute the non-diluting offer price, it is simply the price earning ratio of the predator before the merger or acquisition. We multiplied by earning per share of the target also before acquisition or the merger. So we come up with that. Then remember price earning ratio. Remember the price earning ratio. The price earning ratio. So this one is your price earning ratio. It is supposed to be given by market price per share divided by the earnings per share. So this one here is your price earning ratio. So to get this price earning ratio, so this one will be your price earning ratio. So to get that price earning ratio, it is simply market price per share divided by earning per share. It is simply the market price per share we divide by the earning per share. Also, the share premium. When you also want to compute the share premium, also when you want to calculate the share premium. So share premium, the share premium is supposed to be given by the offer price. We just take the offer price. We subtract market price per share of the target. We subtract market price per share of the target. Market price per share of the target. So when you want to compute the share premium, it is simply the offer price minus market price per share of the target, minus the market price per share of the target. We subtract the market price per share of the target. So that's now the summary of the information we can be able to get on the mergers and acquisition. So from that point, I want us now to check some questions in your past papers. From that point, I would like us now to go through some questions from your past papers. So the first question I would like us to start with November 2019, question 5, part B. November 2019, question number 5, part B. We can start with the question for November 2019. Question number 5, part B. November 2019, question number 5, part B. We can go through the question for November 2019, question 5, part B. So that question 5, part B is about A Limited and B Limited. A Limited and B Limited are companies operating in the same line of business. So in the past few years, A Limited has experienced stiff competition from B Limited to an extent that A Limited is now contemplating acquiring B Limited in order to consolidate its market share. In order to consolidate its market share. So the following financial data is available about the two companies. The following financial data is available about the two companies. So they gave you A Limited and B Limited, where you have been given annual sales, the net income, ordinary shares outstanding, earning per share, then also market price per share, also the market price per share. Then both companies are in the 30% income tax bracket. Both companies are in the 30% income tax bracket. So required Roman letter 1, required Roman letter 1, maximum exchange ratio that A Limited should agree to, assuming that it does not expect dilution in its post-acquisition earning per share. Roman letter 2, total premium the shareholders of B Limited will agree to receive at the exchange ratio in part B, Roman letter 1 above. Roman letter 3, A Limited post-acquisition earning per share, assuming that the two companies agree to an offer price of 30 shillings. Roman letter 4, A Limited post-acquisition earning per share, assuming that for every 100 ordinary shares of B Limited, the shareholders are offered 12% debentures of shillings 500 per value. So that's now the question. I will start with the Roman letter 1. Maximum exchange ratio that A Limited should agree to, assuming there will be no dilution. But I've given the general formula of calculating the exchange ratio. We have given you the general formula of how to get the exchange ratio, how to come up with the exchange ratio. So to get the exchange ratio, we have said it is supposed to be given by, the exchange ratio is supposed to be given by market offer price by the breedetta, offer price by the breedetta, offer price by the breedetta. Then we divide by market price per share, market price per share of the breedetta, market price per share of the Predator, the market price per share of the Predator. But now the question wanted non-diluting offer price. The question wanted you to compute. So to calculate non-diluting exchange ratio, to get non-diluting exchange ratio, it will be given by non-diluting offer price. Non-diluting offer price. Non-diluting offer price. Non-diluting offer price. Then we divide by market price per share of the Predator. We divide by the market price per share of the Predator. Like that. So that's now the summary I will be able to show for that Roman letter 1. So the general formula of exchange ratio is simply the offer price by the Predator. We divide by market price per share of the Predator. But this question wanted maximum exchange ratio, where there will be no dilution in the earning per share. So that means they want you to compute non-diluting exchange ratio. The only difference now, the offer price will be non-diluting offer price. The offer price will be non-diluting offer price. So I've given you the formula for the non-diluting offer price. Non-diluting offer price. So non-diluting offer price, it is supposed to be given by the price earning ratio. Price earning ratio of the Predator. The price earning ratio of the Predator before acquisition or merger. Before acquisition or merger, we multiply by earning per share of the target, also before the acquisition or the merger. Then I gave you the formula for the price earning ratio. It is market price per share divided by the earning per share. So L limited is the Predator. L limited will be our Predator. So I want us to check under L limited. What do we have as the market price per share for L limited? So when we check under L limited, so we have a price of 60. So you take 60, divide by earning per share still of L limited is how much? They have given us 4. So that now will give you the price earning ratio. You just take market price per share divided by the earning per share. But we are supposed to multiply by earning per share of the target. The target will be B limited. The target should be B limited. So what do we have as the earning per share of B limited? They're given 3. Yeah, so we can now compute so that we come up with the exchange ratio at that level. So we get 45. Get 45. So after that, we can now get the exchange ratio. We can now compute our non-diluting exchange ratio. We simply take non-diluting offer price, we divide by market price per share of the Predator. So now to get our non-diluting exchange ratio, our non-diluting exchange ratio, it should just be equal to market price per share. So non-diluting offer price, which is 45, then divide by market price per share of the Predator is how much? 60. So that we get that particular exchange ratio. 0.75. So it should be a ratio. It should be a ratio that will be 0.75:1, because we need to get them in terms of the shares. We need to get them in terms of the shares. So the ratio is 0.75:1. 0.75:1. But we need to make them as shares. We need to make them as shares. So making them as shares, you can see 0.75:1. We need to get the least common multiple. It will be 0.25. It will go there 3 times. It will go there 4 times. We need them in form of shares because there are how many shares to be issued in order to acquire 1 share. So this one will be the same as 3:4. 3:4 because of the least common multiple. Or alternatively, you use your calculator. You use your calculator. So in your calculator, there is this function. In your calculator, there is that particular function. I had shown you sometimes back how to use it. I had shown you how to use it. So you just press 0.75 to get the answer. Then you press this side and see what it will give you. 3/4. It is the same as 3:4. So this one is the predator. This one is the predator. Then this one is the target. So our exchange ratio is 3:4, whereby the predator will be giving 3 shares in order to acquire 4 shares of the target. So maybe you can just write here something brief by noting that this implies that the predator will issue 3 shares. It will issue 3 shares in order to acquire 4 shares of the target. It will issue 3 shares in order to acquire 4 shares of the target. It will issue 3 shares in order to acquire 4 shares of the target. In order to acquire 4 shares of the target. In order to acquire the 4 shares of the target. In order to acquire the 4 shares of the target. So that is now what we should be able to come up with in that portion. So we can now go to the Roman letter 2. Roman letter 2, they wanted you to compute. When you go to the Roman letter 2, they were asking you to calculate. When you go to the Roman letter 2, they were asking you to compute the total premium the shareholders of B Limited will agree to receive at the exchange ratio. So this is now how to compute. This is now how we shall be able to calculate the share premium. So share premium, the share premium, it is supposed to be given by the offer price. The offer price. We subtract market price per share of the target. We subtract market price per share of the target. Market price per share of the target. So just a minute. So what were we able to get as the offer price? The offer price was 5. So market price per share of the target. What should be the market price per share of the target? The target is being limited. It is not market price per share is meant to be 30. The market price per share is meant to be 30. So it will be able to give us which here. So it will give you. So to get the total share premium, so we need now to get the total share premium. Total share premium at the exchange ratio. How to get the total share premium at the exchange ratio. So total share premium, you simply take the 15 multiplied by 4. Remember the shares of the target at the exchange ratio? The predator was offering 3 shares in order to acquire 4 shares of the target. So this is the share premium per share. But how many shares were there for the target at the exchange ratio? There were 4 of them. So you take 15 multiplied by 4. You take the 15 multiplied by 4. You take the 15 multiplied by 4. Yeah, so that should be now our Roman letter. That should now be the Roman letter 2. So where they wanted you to get the total premium of the shareholders of B Limited that we agreed to receive at the exchange ratio. So we now go to the Roman letter 3. We now go to the Roman letter 3. Roman letter 3 will be A Limited post-acquisition earning per share, assuming that the 2 companies agree an offer price of 30. Assuming that the 2 companies will agree on an offer price of 30. So when you want to compute, Roman letter 3, A Limited post-acquisition earning per share, assuming that the 2 companies agree on an offer price of 30. So we compute the new exchange ratio because they have given you a new offer price. And remember, it is share for share exchange. That Roman letter 3 will be the share for share exchange, because they are saying that post-acquisition earning per share, assuming that the 2 companies agree on an offer price of 30, an offer price of 30. So we compute the new exchange ratio. So exchange ratio, it is supposed to be given by the offer price. The offer price by the predator. The offer price by the predator. We divide by market price per share of the predator. Divide by the market price per share of the predator. So this time round, they have given you the new offer price by the predator. They have given you the new offer price by the predator. So that new offer price by the predator, the new offer price by the predator, it was given as how much in the Roman letter 3. So they were able to give you a price of 30 we divide by market price per share of the predator. Remember, it was which price? It was meant to be 60. So, the same as 0.5. So, if you follow the format I've given you, it's the same as 1:2. It's the same as 1:2. That implies that, maybe you can comment that, it implies that the predator is offering 1 share. The predator is offering 1 share. The predator is offering 1 share in order to acquire 2 shares of the target. The predator is offering 1 share in order to acquire 2 shares of the target. In order to acquire 2 shares of the target. In order to acquire 2 shares of the target. So from there, now to calculate earning per share of the predator. Earning per share of the predator. Remember, it was the combined earnings. The combined earnings of the predator and the target. The predator and the target. Then we will divide by the number of the ordinary shares of the predator. Number of the ordinary shares of the predator. Then we add the new shares to be issued. New shares to be issued. Divided by the new shares to be issued. So, combined earnings are meant to be the net income. The combined earnings are meant to be the net income. There is 40 million plus 9 million. There is 40 millions. 40 millions plus 9 million. So, number of the ordinary shares of the predator. Number of the ordinary shares of the is the one for A Limited. Ordinary shares outstanding for A Limited. There were how many shares? There were 10 millions. So there's something we have forgotten up here. We need to get the number of the new shares to be issued first. So maybe just a working, you can leave that space and do a small working down there. Number of the new shares to be issued, we have not calculated. So number of the new shares to be issued, you can do a small working down there. Number of the new shares to be issued. 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 So for every 1 share, we exchange it 2 shares. Exchange it with 2 shares. So the target is B Limited. B Limited has got how many shares? B Limited has got how many shares? Ordinary shares outstanding for B Limited. There are how many? 3 million ordinary shares. There are 3 million ordinary shares. So how many shares should be issued? We cross exchange. We cross multiply to get the value for that. Sorry. 1.5 minutes. So now we come down here. Existing number of the ordinary shares. The number of the ordinary shares for A Limited, they were 10 millions. But now we are issuing how many shares? 1.5 million shares. Issuing 1.5 million shares. $4.26. So we get 4.26. Get 4.26. 4.26. So that now will be able to give you what is supposed to be. So, but sometimes in the same question, they may ask you to calculate. They may ask you to calculate the one for the target. So this one, they wanted you to compute the one for the data. They wanted you to compute the one for a limited. Assuming they wanted for both. Assuming they were asking you to compute for both. So apart from the one for the predator, we can also compute the one for the target. We can also calculate the one for the target. We can now also compute the one for the target. So to compute acquisition earning per share of the target. If you want the one for the target, you take the one for the predator, you multiply the exchange ratio. So you simply take exchange ratio multiplied by the one for the predator. Earning per share of the predator, the one for the predator. So to compute the post acquisition earning per share of the target. So exchange ratio was 1:2, which is the same as 1/2. Then multiplied by 4.26. Just in case they ask you the one for the target. Anything for the target, you simply take the exchange ratio multiplied by the one for the predator. Multiplied by the one for the predator. Multiplied by one of the predator. So now we go to the Roman letter 3. Roman letter 3, they were saying, so Roman letter 4, not 3. A limited was the acquisition earning per share, assuming that for every 100 ordinary shares of B limited shareholders are offered 12% debentures of $500 per annum. So now we want to see how to compute. So this one was share for share exchange. Roman letter 3 was share for share exchange. Now we want to check when it is use of the debentures. When it is meant to be use of the debentures. So Roman letter 4. Roman letter 4 is meant to be use of the debentures. Use of the debentures. Use of the debentures. So when it comes to the use of the debentures, earning per share of the predator. Earning per share of the predator. It is supposed to be given by the combined earnings. The combined earnings of the predator and the target of the predator and the target. Then we minus. Then we need to minus the debenture interest. We minus the debenture interest. Then we add interest tax benefit. Add interest tax. Interest tax benefit. Then we divide by the number of the ordinary shares. Number of the ordinary shares. Divide by the number of the ordinary shares of the predator. The predator. So we should first of all get number of the debentures to be issued. We need to come up with number of debentures to be issued. We need to get number of the debentures to be issued. So they have stated that they were able to, the shareholders are offered 12% debentures. 12%. So for every 100 ordinary shares, there are 2 debentures. So 2 debentures. 2 debentures are equivalent to 100 ordinary shares. So 2 debentures are equivalent to 100 ordinary shares. But the target had how many ordinary shares? It was 3 million. 3 million ordinary shares. So how many debentures you have to be issued? So how many debentures will have to be issued? How many debentures will have to be issued? How many debentures will have to be issued? So there are 60,000. So once you get the 60,000, we now compute interest. We now calculate. So it will be 60,000 debentures. 60,000 debentures. Then we multiply by the bar value per debenture was which figure? The bar value per debenture was 500. Then interest rate was given as 8%. So multiply 500. Then you get 12% of that. Get 12% for that portion. $3.6 million. So now we go back to compute that earning per share. Share of the predator. So combined earnings, they are the net incomes. The combined earnings are meant to be the net income. So there is 40 millions. There was 40 millions plus the 9 millions. Those are the combined net income. But we subtract interest, which is now meant to be 3.6 millions. Interest is 3.6 million. Then we add interest tax benefit. So to get the interest tax benefit is simply 3.6 million multiplied by the tax rate, which was given as 30%. Then we divide by the number of the ordinary shares of the predator. Number of the ordinary shares of the predator is A limited. They gave us how many ordinary shares? 10 million. They are meant to be 10 million ordinary shares. They were meant to be 10 million ordinary shares. They were meant to be 10 million ordinary shares. So that should be able to give you the value for that. That is meant to give you the value for that portion. So there is another question for December 2021. It was the exam paper, December 2021, question number 2, part B. But I don't know whether the time will allow. Exactly 10. So there is a question for December 2021, question number 2, part B. But I suspect that one we shall carry it forward because our time was meant to be up to 10. We only have 10 minutes remaining. So I will do it in the next class. So remember when we meet, you remind me, we do December 2021, question number 2, part B. That is for the exam, not the pilot. So we can stop there for now.
But we don't have an extension, imagine if we stay on an extension. It's not an extension. What's going on? Yeah. What's going on? Yes, it was. Extension.
Janda kanisa.
Sisi tunaitaka asubuhi